Evening, everybody. What a week! What a week it has been in mortgage land. So I've come on live today to chat to you all a little bit about what's been going on, the reasons why it's been going on, and basically kind of giving you a bit of a live update. I've got my emails to the side of me. As to sort of who is withdrawing rates, a bit of an idea. We're starting to see rates come back to the market. So I've purposefully sort of saved some emails next to me so that I can run through, talk to you a little bit about kind of the differences in rates. I'm going to literally, as I'm looking through them, I'm going to go on the lenders' websites. We're just going to talk through what's happening, what rates are available, give you a real snapshot as to what's going on. So this live is all about mortgages. We're not really going to talk much about bridging finance, development finance, any of that sort of jazz, commercial mortgages. We're really going to focusing on buy-to-let mortgages in particular. That's the main thing that we're going to be focusing on. The big thing that I guess is I talk about and I deal with my clients. Just to give you a bit of an intro into who I am, if you don't know who I am or haven't come across me before, my name's Sam Norris and I'm the owner director of Grand Union Finance. I'm also known as the property investors broker because I've been doing this job for 16 years, basically being a mortgage broker and arranging finance for property investors for quite some time. So that's why I'm a firm believer that residential mortgages and buy-to-let mortgages are very, very separate, two very, very different things. And as a result, I wanted to try and keep this kind of separate and focus in on the part of the market that I am keeping my eye on more than any other. So what has happened? Let's talk about what's happened so far to start with, and then we'll move on to I'm going to look at these emails that are staring me in the face to the right-hand side of me. So about early last week, we started to hear some noise that there were going to be some changes in the mortgage market, not necessarily in a good way. So what we were hearing was that there was going to be some changes in what we call the SONIA rates or swap rates. Now, obviously, last month we saw the Bank of England the Bank of England raise its base rate yet again, this time up to 4.5%. But what happened off the back of it, which hasn't really happened for the last 2 or 3 months, is there was a lot of noise coming out basically saying this is not the last of the raises. We've seen the base rate over in the US go beyond 5%. It's a really good indicator of where our base rate tends to go, because if you look historically, we seem to match the base rate over in the US quite a lot. So I think with the rate going up again, inflation not coming down to anywhere near where we really predicted it to be this year, really the biggest tool that the Bank of England have in fighting inflation is to increase its base rate and continue to increase the base rate. So not noise coming out that the base rate was increased, but further base rate increases predicted pretty quickly. To give you some context, the last couple of times that the Bank of England have actually raised their base rate, we've seen that the Monetary Policy Committee, which is made up of 9 individuals at the Bank of England, is their job every month to vote on whether the base rate goes up, down, sideways, backwards, upside down, whatever. We were seeing that some people were voting to keep it as it is or voting for smaller increment raises. That didn't happen this month. It was pretty unanimous. And as I said, predictions were abound that we were going to see a continuation of that over the next couple of months. Certainly predictions that getting to 5% was almost a nailed-on, foregone conclusion. Getting beyond that was perfectly feasible. Now, I've been asked a lot across my channels about whether or not I think that the Bank of England base rate will come back down at some point this year. I can't see it happening this year. I really can't. Unless something major happens and inflation absolutely storms it and gets down probably below 5%. I just can't see the base rate coming down. I can definitely see it coming down next year, not to the levels we've been used to over the last decade or so, but certainly coming down, which should make things a little bit more easy for us to manage. So the reality of it is that the mortgage market is going to be pretty choppy, pretty difficult to manage over the next 6 months at the very least. And us mortgage brokers are going to have to do, we're going to have to work hard and help our clients. So off the back of the news that came out that was suggesting that, we're going to continually see more base rate increases, the swap rates got ahead of themselves, essentially, and we started to see a big increase in the swap rates. Now, the swap rates, for those that aren't sort of knowledgeable on this particular subject, are the rates that lenders lend money to each other. So we have some big institutional banks in the UK. So we've got your Citibanks, RBS, JP Morgan, these kinds of banks, and they've got crap tons of money. Basically, they are the pinstripe brigade, and they've got loads of money. And what they do is they lend a lot of that money out. So when these big banks are saying, like, we are going to invest your money, sometimes they're investing it by lending it to other lenders, other banks. It's crazy, right? But this is why we've got such a sophisticated lending market in the UK. I'd say it's probably the best in the world in terms of the level of sophistication we have. I mean, it's been going on for a while. The banks in the UK have been around a while. A lot of them have anyway. So that's how they lend money to each other. And by the way, I mentioned RBS there. There's a really good reason why the government bailed out RBS back during the credit crunch. And it wasn't because they loved all the guys that were getting paid, stupid bonuses. It was that they knew that letting RBS go to the wayside took away a big player in the lending market, because a lot of the money that they had gets flows down. So they'll lend to a couple of larger banks who might then lend down to a couple of smaller banks who will then lend down to challenger banks who lend down to small bridging lenders. So it all kind of flows down, so to speak. So, but it starts at the top, and basically we have these sort of rates. We call them SONIA rates, and what the rate is will depend on how long you want to borrow the money for. So the shorter, 1 year, 2 year is quite expensive at the moment, and it starts to get a little bit cheaper as you go further along, because you can kind of make more predictions longer term than you can short term at the market. At the moment, I should say, back in the day, we would find that 2 year fixed rates on a mortgage were generally cheaper than 5 year fixed rates on a mortgage, and that's because the swap rates were we could predict the money over a 2 year period a lot easier. There's a good reason why there aren't a lot of 1 year fixed rate mortgages about, because it's actually not that easy to predict money over that period of time. And it does become kind of like short-term funding. And we all know through bridging finance that short-term funding compared to mortgages on the whole can be quite expensive. So as those rates started to increase, the market got a little bit concerned, because what happens is when you actually take out a fixed rate mortgage, what happens is that the lender is betting on the fact that they're going to make a margin. So although your fixed rate might be, let's say it was 5%, now they are borrowing that money. They've then agreed to borrow some money, but until you complete, that money is not fixed for most lenders. Only the lenders that are lending their own money can fix their own rates. Otherwise, they're basing it on the swap rates. So what that means is that until you complete, there might be a 3-month period where the lender is concerned that they might actually end up losing money on that particular deal. It's crazy. It's absolutely crazy. So when we get to a point where swap rates become quite volatile, and the last time we saw this was back in September time when we had the Liz Truss kamikaze quasi mini budget bonanza, a similar thing happened. Because the swap rate started, because basically the market started to lose confidence in itself, or was starting to get a bit concerned. At that point, lenders just started pulling rates from the market because the swap rates started going all over the shop, and they couldn't predict what the cost of the money was going to be. Therefore, they couldn't have any products. A similar thing has happened. I wouldn't say it's necessarily down to loss of comfort in the market. It's that we need to wait for the swap rates to settle down a bit. Swap rates, like currency, can move up and down constantly. So we wanted to start seeing a little bit of the rates were just going to settle a little bit, so lenders could start predicting what was going on. In addition to that, because we actually, although we say we can't really predict, we could predict to a certain degree. So we had to wait and see just where they were going to settle. We knew they were going to be higher, but rate lenders were like, right, we can't be lending out money at 5% anymore. We can't be lending out money at 5.2% anymore. So we've got to pull these rates in, because if we continue to lend money out like this, we know that in 3 months' time, we're going to be losing so much money, because there is going to be a quick shift, because we've had a Bank of England base rate and it's pretty much nailed on that it's going to be another base rate increase next month and next month after that. So why not get ahead of the game? Because we are basically going to be hedging our bets over that period of time, and swap rates have been basically gone up to fall in line with what the predicted base rate is going to be maybe in a couple of months' time. So lenders then pulled money out. Pulled products off the market, stopped lending money to a certain degree for a couple of days, just so they could then reevaluate and then start putting products back on. So what have we seen over the last last week or so? Right. So Kent Reliance pulled rates, Precise pulled rates. I'm looking here. We've got, let's go through some of the ones on here. Who else pulled rates? Keystone pulled rates. Paragon pulled rates. We've just had confirmation from Pepper. They've given us a withdrawal notice. So what happens is lenders will give a withdrawal notice. So Pepper Money here, for example, they are a specialist buy-to-let lender. They are giving us till 5 p.m. on the 1st of June to get a full mortgage application in. Okay, so overnight on the 1st of June, to secure your existing products, please submit your decision in principle to illustration status with your chosen product selected. With your chosen selected product selected by the 5 p.m. on Thursday, the 1st of June. Okay, cool. Then by midnight on the 5th of June, we regret that we will not be able to honour any cases that miss these deadlines. Okay. So 1st of June, and then full mortgage application, has to go in by 5 p.m. So this is the kind of thing that we get. Just give you some insight. I'm just reading it straight away. I haven't even read this email today. You think I've had time to read these emails? So great example of an email that we get from a lender. Says overnight on Thursday, the 1st of June, 5 p.m. We'll need to get a decision in principle in with them. And then by 5 p.m. on Thursday, the full mortgage application has to be and fees paid by the 5th of June. Okay, so get by the 1st of June, full application in on the 5th of June. So basically, we need to start the process, and then they're going to withdraw those products. So they're out. They're going to be bringing back some new products. Accord, they pulled out loads and loads, and then they've come back with a few now. Kensington, exactly the same. Okay, so all these lenders have pulled out, readjusted, reevaluated, and now they are coming back in. Okay, so Kensington again, decision principles produced, a mortgage application commenced by 5 p.m. on the 1st of June. So that's tomorrow. Full mortgage application needs to be submitted by 5 p.m. on Wednesday, the 7th of June. So actually, that's quite a nice notice period. When all those product withdrawals happened, like back in whenever it was, September time, lenders were giving us like 4 hours notice sometimes. Like, how the hell is that ever? I mean, they did that on purpose because they know that no one's going to be getting them in. Now, what happened, and I predict a similar thing now, not to the same sort of level as happened, what happened this time, what happened last time was, because you had these rush of mortgage applications, lenders were getting a huge number of applications occur in a short space of time, okay? Which means that a big queue formed, which means it took longer to process applications. So that's effectively what's going to happen. Now, I just want to, I've actually opened up another, an interesting article that I thought I would share with you guys as well, which from Mortgage Solutions magazine, which is titled "Product Withdrawals: A Rerun of Last September, Though Worst may be Over." A swat of product withdrawals and repricing over the last week have left brokers feeling a sense of deja vu. Yes, we have. Advisors have said, though there is some optimism that further changes are unlikely until there is more gloomy economic data. So basically what they're saying is we're hedging our bets, man. We know that there's going to be increases in the Bank of England base rate. So we're getting ahead of the game. We're increasing our rates now. Around a dozen lenders have pulled selected mortgage products within the last week or so, while some have pulled their entire fixed rate range. Yes, they have. The level of choice also dropped notably, the number of mortgages on the market dropping from 5,300. Shall I start again? 5,385 at the start of last week to 5,012, according to data from Money Facts. Brokers said that the situation has been a retread of what happened last year following the mini budget. Blah de blah de blah de blah. So let's just scroll down a little bit because there's another bit down here that I wanted to read through with you. This bit is entitled "Is the Worst Over?" Justin Moy, managing director of EHF Mortgages, never heard of them, said that given the majority of mortgage lenders adapting their rates on offer, he did not expect many more changes in the coming days unless further data is released, which makes the gloom a bit darker. He said that it's been the specialist lenders who are most exposed to swap rate fluctuations who pull their rates most swiftly. Yeah, so just to pick this apart, okay, I'm not sure who Justin is. I've not come across him before. So like I said, they're hedging their bets, and we should have hit the worst. We've basically gone through sort of a 7-day period where the shit has hit the fan and we've kind of gone through the worst of it, essentially. And what they're saying here is unless more information comes to light over the next couple of months, realistically, we're at our potentially we've gone from the bottom almost up to our peak. Now, what this does mean is, as much as the Bank of England base rate is probably not going to come down this year, we could see, once there's a bit of stability in the market, potentially mortgage rates might come down a little bit. Now, as it says in there, and this just goes for those of you that were hit on here earlier and listening to the bit I was talking about the swap rates and the lending trickling down from above, the specialist lenders that we're talking about here, the ones I've been mentioning, these specialist buy-to-let lenders, they are 3 or 4 rungs, maybe even 4 or 5 rungs down in terms of the lending. Okay, so you've got JP Morgan lending to Barclays, lending to Shawbrook, lending to a specialist buy-to-let lender like the mortgage lender, for example. So that's quite a few different lends. So it means that the ones at the bottom are more exposed to fluctuations in the swap rates. So it's no surprise that those are the lenders that have been pulling rates and readjusting their products, basically. So that's one thing that I wanted to look at. Now, just across the board, I saw this in Mortgage Strategy magazine today, an article by David Burrows, good old Dave. Rightmove's weekly mortgage tracker shows that for an 85% loan to value 5-year fix, now we are going into residential a little bit here, the average rate for 31st of May is 4.5, which is up significantly on the 3.01 at the same time last year. So that's 85% loan to value. For a 60% loan to value 5-year fix, the rate is up 0.1% on last week at 4.38, and this compares to 2.68 last year. So it just goes to show 95% 2-year fixes, again, have gone up in the last month, 0.15, and that's up to an average of 5.74%. The same rate last year was 3.31. Crazy. Now, I'm not a big fan of 95% loan to value mortgages, almost as much as I'm not a big fan of 100% loan to value mortgages, so don't take those out anyway. But yeah, just thought it was really, really interesting to show what big change there has been. So what we'll do is should we go and analyze or have a look at a few changes in rates? Okay, so first and foremost, Accord. I'll start with Accord because they're probably the most mainstream of these lenders, but they haven't given an actual rates on the screen here in the email. Can have a look at those on their website, but they actually show the increment of the increase. So I'm not going to bother with 60 and 65%. 75% 2-year fixed rates across the board are going to be increasing by 0.42 to 0.61%. Quite a big overnight increase. 80% by 0.52%. 75% 3-year fixed rates from 0.52 to 0.53%. 75% 5-year fixed rates 0.51 to 0.58%. So we're talking pretty much an average across the board, over 0.5% increase. Now, bearing in mind the Bank of England base rate went up by 0.25. This is averaging over 0.5% on a relatively mainstream specialist lender. So Accord are the broker arm of Yorkshire Building Society, basically. So let's have a look at the next one. So Paragon, everyone's favorite lender. Okay, so let's have a look. These are quite cheap still. So for portfolio, still 5-year fixes 5.35 and 5.6. 5.35 on their green range. So a lot of lenders now offer reductions. I think it's incentivized by the government. If your EPC rating is A, B, or C, you get you can get a green mortgage, and you get a bit of a knockoff on this. In this instance, 0.25%, 0.25% off. 5.35 on their 5-year green fixed rate and 5.6% on their 5-year. These are for portfolio landlords. So to be honest, although bearing in mind their rates started with a 4 last week, so the fact that they're well into the 5s now just goes to show that there's been a pretty reasonable increase. Let's get to the next one. Let's talk about Keystone. So 0.5% on the 5-year fixed rates and 0.65 on their complex. So they're starting on their complex fixed rates. Keystone, who are like pretty decent lender, 6.44% buy to let. Nuts, man. Right, let's have a look at that's actually should we go into the product range and have a look? So let's have a look. Complex range 6.44, 6.54, 6.69, 6.79. That 6.69 is at 65% loan to value as well. That's freaking nuts, man. I'm doing this on purpose. Like I'm looking at it live on purpose because I want to show you my reactions. I'll have a look at Kent Reliance now. So Kent Reliance products, buy to let mortgages. Let's have a look. Yowza trouser, right? 75%, 5-year fixed. That isn't too bad. 5.79%, but you're going to pay a 2.5% fee on that. I'll come back to talking about that in a sec. 75% with a 1.5% fee is 5.99. They're offering 80% loan to value mortgages, 5-year fixed rate, 6.29, 6.49. So pretty reasonable. Let's have a look at Precise. Been annoying me recently, Precise. So Precise buy to let. Oh, why do they do this? Got like an advert come up over the top, so you can't actually move your screen. You can't actually click on anything because you've got a bloody advert in the way. Oh well, looks like we might not be able to look at Precise. Oh, accept cookies, is that it? Oh, ridiculous. Anywho, right, let's start again. Right, so buy to let mortgages. Buy to let mortgage specialist buy to let guide. Okay. So this is for limited company. So we're talking. So bearing in mind, Precise is generally one of the more cheaper lenders in the market. So 5-year fixed rate, 75%, 5.49, 5.69. They were at 4. They were in the 4s last week. 80%, 5.99, 6.19. So they've HMO 5.59, 5.79. That's pretty decent actually. So that's good. Who else we got? We've done Paragon. Let's look at, see if Foundation home loans. So look at them. Should put for intermediaries. There we go. So look, we get our own website, intermediary websites. Okay. Buy to let product guide. New. Whoa. Okay, now we're seeing some action, boys and girls. 2-year fixed rate, 7.14%. 5-year fixed rate, 7.24%. They are at 80% loan to value. So I'll let them have that. Standard 5-year fixed rate, 75%, 6.84. Do you know, I applied for a mortgage for a client for a 5-year fixed rate with a commercial lender at 6.69 last week, and Foundation Home Loans, who are just a specialist mortgage lender, 6.84. That's a lot, isn't it? 5-year fixed rate. Their other 5-year fixed rate with no early repayment charge or low early repayment charge is 6.89. Okay. And if you've got some credit issues, you're well into the 7s. Yeah, well into the 7s. So just gives you an idea of kind of where we're at. If you've got any questions, by the way, feel free to chuck them into the comments. I'm more than happy to answer any questions you guys have got. So yeah, that's what the market's looking like at the moment. Pretty cool. Not pretty cool at all, really. Not pretty cool at all. Not pretty. What's going to happen now? So, as I said, this is mainly affecting the specialist lenders because they're the people that are most they are most affected by the volatility of the swap rates. So, you can definitely see why they're being affected. What hopefully will happen is we will see see the volatility just settle down a little bit. Particularly if we're starting to get more sort of better news, potentially with news of more Bank of England base rate rises coming, that might have a positive effect on inflation, which would have a knock-on effect on confidence in our market, would have a knock-on effect on swap rates, would have a knock-on effect on mortgage rates. But I think we're in these sorts of areas for the next month or so, I would probably say. That's where we're going to be at. So what I'll probably try and do is keep these sort of videos coming, keep you guys updated. So if any of you want to reach out, you want to have a chat, you want to talk about your plans, and what I'm talking about here is people that are probably at the early stage of their property investment journey, need to have a conversation with somebody you can talk about, like, this is my strategy, these were the finance options I was looking at, this has all changed. What do I do now? I do have a one-to-one property strategy call that you can sign up for. I will put this after this finishes. I will put the link to sign up and book yourself in for a one-to-one half-an-hour call with me into the comments or the notes below the description, yeah, you can book in a call. We can have a chat. We can go through everything. Generally speaking, on those calls, I get the whiteboard up, and we do a few visuals, and we can talk about anything you want. So we can talk about your strategy and then how changes in the mortgage market are going to affect that and how we can find some solutions to it. If you've got a deal that you're looking at right now and you need some assistance right away, best thing to do is drop a comment below, and what I can do is get in touch direct, and we can book in a time to speak to either myself or one of the team at Grand Union Finance to help you out. Or go and follow me over on Instagram at the Sam Norris. Send me a DM in there if you need some help, if you've got any questions. Again, depending on what your situation is, we'll get either myself or one of the team at Grand Union to give you a call. All qualified mortgage brokers to enable you to get the advice that you need. But guys, thanks so much for coming on at 9 p.m. on a Wednesday evening to get to run through this with me. I wanted to do this live. I wanted to you to see my reaction as I'm going through these. Hope that was really, really beneficial. Hey, Genevieve. Awesome name, by the way. Thanks for coming along, guys. Thanks for joining. And yeah, I will see you on the next live video. Have a cracking evening. Enjoy the rest of your week. Stay safe, peeps.